Welcome to this session of Eyeway Encounters. Our guest today is Piyush Rakhecha, who is a financial planner and a wealth manager. He's from Calcutta, and he's also an MBA from IIM Raipur, right?
That's correct.
Yeah. And I would also like to say that, you must be wondering, many of you would know, but many of you may not also know that Eyeway is basically a knowledge resource on living life with information. We try and share information that is useful to people who are blind. And we also run a helpline, which people can call if they need information. 1-800-53-20469 is our help desk number. We take calls in Hindi, in Marathi, in Malayalam, in Kannada, in Urdu, Kashmiri, and in Odia. So that's the thing. And welcome to this session, which will be essentially on certain tools for helping one with wealth and financial planning and management. So Piyush, it's all yours. So till we wait for 5-10 minutes, you can start engaging with the participants and getting a feel of what the mood is like.
Yeah, thank you so much, George, sir, and thank you, and I'm grateful to the entire Eyeway platform to bringing me here in and helping me share about financial planning and certain ideas and certain tools which I'll be sharing later. So I wanted to understand what is the expectation. If anyone could share, what is the expectation from this session? So I would like to you to first tell me your name, where are you from, and then your expectation from this session. Anyone can unmute and start speaking.
Okay, my name is Siddharth.
Yeah, hi Siddharth.
Hi. So I'd like to know, I'd like to invest in equities, yeah.
Okay.
And with a very clear goal of, obviously minimizing risk and trying to get maximum gains. Very simple.
Correct.
But the aim is to invest in equities. I watch the market every day.
Right.
Yeah, from the opening onwards. Before the opening, actually.
Very good.
Before the opening.
Right.
I watched the CNBC show from 8 o'clock in the morning. Yeah, till the opening.
Very good.
And so I understand the basics. I've also dabbled in the market. I've burnt my fingers also. Yeah.
Okay.
Thanks to all those various factors of risk of greed, fear, blah blah. Yeah, all that. Then the human element of not being able to, take the right decisions at the right time, or just whatever. You know what I mean? And then being rash, not putting an SL when it's required, silly things like that. Yeah.
Right.
And so I wanted somebody, who could help me, not right now during the session, but post this, where I could basically start investing in equities again, and hopefully make gains out of it and not losses. So in short, that's what it is.
That's very good. And so basic expectations that you have is to know more, and basically you have the understanding about equities, but to be able to invest in a way where you can minimize your risk and maximize return. Sure. We'll try to cover some part of that where you'll be able to take those kind of decisions.
Fair enough.
So thank you so much. Thank you. Anyone else?
Thanks.
Anyone else would like to go?
Hi, this is Sachin from
Hello, sir. My name is Sumanth.
Yes. What's your name? Sorry, I missed that.
Sumanth.
Okay. Hi, Sumanth.
I'm from Karnataka, Bangalore.
Yes.
I'm just 19 years now.
Okay. That's good. That's good.
I'm into share market.
Yeah.
Since I have a very good future in this thing coming up.
Yes.
Yeah, share market is a good option because in long term we can gain more, accumulate more money.
So you're talking about share market as a side income?
No, actually, yeah, somewhat like that.
Okay, great. Okay.
Yeah, I'm interested in the share market, equity market.
Okay.
Yeah, and I have also learned the basics, and from 6 months I have started investing also.
Yes.
Yeah, I have to learn this share market, the depth of the share market, and go on with it.
So Sumanth, why only equity?
Because it's having a good future, so indeed.
That's good. That's good. That is excellent that you have faith in the future. So future, I would just recommend you for the time being that future means time in the market. You need to give time in the market, and you have lots of time. Since you
Yeah.
are just 19, you have good at least 30-40 years of making wealth, making fortune. People were
Yes,
talking
yes.
about that. Lot of them are not able to have abundance of financial assets or wealth. So I ensure you, even if you put even small amounts from now, starting now, you will be able to accumulate a fortune at the age of 50, 55. That's for sure.
Yes, sir. That's true.
Yeah. Thank you so much. Anyone else would like to?
Hello, sir. This is Sachin from Karnataka.
Yeah. Hi, Sachin.
Yeah, hi, sir. Actually, I want to know that how to observe the patterns of dojis and all. So, because I don't know, being a visual impaired, how to observe those patterns and how to analyze the things. So, may I know how to get all those things with this section? Is it possible as a visual
Right.
impaired?
Patterns are out of today's discussions, but yeah, if we connect later on one to one, then I can explain this to you, because it's very difficult to explain patterns. And myself, if you take my understanding, I know about patterns and charts, but I don't use any of them in any of my activity. So
Sure.
if you want to know more, I can take that up
No.
one to one.
Actually, I have one doubt. Like, even without knowing a pattern, can we invest? Like, being a visual impaired?
Yes, obviously, for sure. See, patterns and charts are required for trading, not for investing. So if you are an investor, if you are a long-term investor, by investor I mean 5 years, 10 years. If you have that much time, if you want to give that much time to investments, then you don't need to see those charts. There are other ways to analyze and pick and choose equity and pick and choose stocks to invest.
Okay, sure. And then I want to know the apps which are accessible with the screen readers, so that I can start investing. I am slowly started getting the knowledge.
Okay, I
of
will
those.
cover that up at the back end.
Sure, sir. Thank you. Yeah.
Anyone else? We'll take one or two more, and then we are good to start.
Hello, excuse me. Hello, I am Satyanarayana. I generally do invest in mutual funds, and I also did certification from National Stock Exchange in the fundamentals of mutual funds. Actually.
Okay. 5A you're talking about? NISM 5A?
5A? NISM
5A. Did you do that one?
No. From NSC also will give fundamentals in mutual funds and their certifications. That I did actually. And I want to become. I am also basically I'm a software engineer, but apart from this, I am also have keen interest in financial investment and all.
So you are looking at mutual funds for a profession, or you're looking to be an investor in mutual funds?
Invested in mutual funds at now presently, but slowly wanted to turn it into a second profession actually.
Okay, that's good to know. Good to know.
Yeah, I will follow CFA related programs also a little bit.
Because in terms of generating income, it's important to diversify also. Apart from job, if you have some other means of earning, it gives you an edge. So that's good that you are thinking about that. Okay. So you have done mutual funds. So what is your expectation from today's session?
I want to understand different kinds of avenues apart from mutual funds.
Okay. Yes. You will learn a lot today then. Okay, that's good. Okay, yeah. Anyone else? Maybe this could be the last one. Yeah,
am I audible?
Yes, you are.
Hello. Awesome. I am Viplav and I am from Delhi and I am a working banker.
Okay.
I have not invested till now, but I am planning to invest. I'm more inclined towards investing rather than trading. So my expectation from this session is that means things that we can look at while investing, and what are the different instruments or securities in which we can invest, and how being a visually impaired can we invest. So these all are my expectations from this session. Thank you.
Okay, great. Actually, your expectations will completely be fulfilled because we'll be discussing exactly what you expect out of it. So that's good. So anyone would like to share their experience? Like someone was mentioning they burned their fingers over investments. So
Good
anyone
evening,
would
sir.
like to share? And yes, go ahead. You want to share?
Yes, sir.
You
I'm
want to
Alok
share
from
your
Odisha.
experience? Yeah.
I want to share some experience from my side.
Yes.
I am using Grow application for investing. Also, I am trading through different share, and
Yes.
I am investing through mutual funds like SBI or Tata.
Okay. So what is your experience? What is your experience from these
Yes,
investments?
before few days, it has too much low due to market condition.
Yes.
But till now it is highly increases.
Yes. So what did you learn out of it? The market going down and going back up again. So what did you learn out of it?
I have learned about it. If we invest through any mutual fund, your balance will be increased, but you keep patience from my side for
That's right.
long
You need
time.
patience and time. Correct. Absolutely. And the thing that you mentioned, market going down and market going back up again, this is called volatility. And equity as a asset, be it mutual, if you are investing in equity mutual fund or if you're buying shares, you are prone to volatility. You have to manage.
Sir,
And it's
I
not...
am working in Odisha in KV, Kendriya Vidyalaya.
Okay. So what I was saying is you need to manage volatility. So volatility in equity is like managing greed and fear. When market goes down, we are fearful, right? That market could go down further. And when market goes up, we are greedy. That market will keep on rising. And if we have heard the word FOMO, right? FOMO. We have FOMO that if we don't invest now, we'll miss out. So this management of greed and fear, if we are able to manage this, we'll be able to make better out of equity, get better returns out of equity. So thank you to all the participants who contributed, because see, today's session is all about discussion. Because what I feel is if you want to gain knowledge, there are enough YouTube videos and other avenues to gain a lot of knowledge on investments and how to invest. But when in a session like this, it's very important that we interact, that I know what you're expecting and you exactly know what I'm speaking. And if you and if we share and learn together in an inclusive way, then I think this session will have its purpose solved. So now let me begin. So George sir has already introduced me. I'll just briefly give my introduction. Completed my MBA in 2015 from IIM Raipur, based out of Kolkata. Last 7 years, I've been doing this financial planning and wealth management, managing approximately 40 crores and in excess of 200 clients. So this is what I have done in the last 7 years, and obviously you might have you'll surely have your financial goals. I also have mine, and it is as far as lot is there to be achieved from here. So now let me begin. I'll begin by talking about a book called Rich Dad Poor Dad. Any of you have read this book? I'm sure some of you would have read this book, or at least have heard about this book. Sorry?
Yes, I read that.
Okay.
I also read that book.
What's your name, sir?
Saravanan.
Okay, great to know that you have read that book. So it's arguably the best book when it comes to understanding about money and how money works. I read this book about 10 years back, and it completely changed how I feel and think about money now. So what does this book talk about? This book actually talks about rich dad and poor dad. So poor dad, actually this is a real story. So poor dad is his biological father, of Robert Kiyosaki, who is the author of this book. So his biological father, or the poor dad, is a very hardworking professor. He has good degree. He has a master's degree, and he's a very hardworking and a successful professor. But he doesn't understand money and how money works. So even though he is earning well, but still he has not been able to accumulate wealth, or he's not financially free. On the other side, there is this rich dad, his so-called father, rich dad, who is just about 8th standard or 9th standard pass, and has very little education the traditional way, but he understands money. He has created a lot of wealth over the years. So this book actually gives us a comparison between both rich dad and poor dad, and through the comparison shows a lot of learnings come out of this comparison. So I will now share a couple of my top learnings from this book, which could help you in understanding certain concepts. So what do we do after getting salary, or once our salary is credited? We start spending, right? First we pay our rent, we pay our EMIs, utility bills, other bills, this fees, that bill, and the list goes on and on. And then we spend on certain luxury items, like we can buy a watch, a smartphone, or plan for a vacation. And once we have done all this, whatever is left over, we think what to do with that money, and we come to sessions like this to understand what should we do with that money, how to make best use of that money. But Robert Kiyosaki, in this book Rich Dad Poor Dad, says that in this way we are making savings actually a byproduct, and it never is a number one product. It is like we are saying that if something is left over after all our expenses, that will be our savings. So if we plot it into a formula, it will be something like this: income minus expenses equals to savings. Am I right? Yes. So now what Robert Kiyosaki says, we need to change this formula to change our life. So formula, what he says is, you should pay yourself first before paying any other bill. So formula he means by this is, income minus savings is your expenditure. So first thing which needs to be accounted for from the income is your savings. Savings ऐसी चीज है जो हमें सबसे पहले इनकम में से निकालना है, और फिर हम जो बचे उस पे खर्च करना है. It's not, I'm sure you would be understanding, it's not a very easy thing to do, because you might say, अब ये बोल सकते हैं कि मेरे पास बहुत जरूरी ऐसे खर्चे हैं जो मुझे करना होगा, जिसको मैं अवॉइड नहीं कर सकता, तो मैं कैसे सेविंग को ज्यादा प्रायोरिटी दूं. But with practice, I'm sure you'll be able to do it, because and a lot of time people tell me, even if I do it, what is the amount that I should save? So that actually depends. It depends on your financial goals, right? Because you need to save for your financial goals. Like, it could be buying a house, planning for retirement. Obviously, everyone has to plan for the retirement. But I would just say that when you think of that number, everyone knows that income. But when you think of savings, just think of one thing, that be very courageous. Don't think that let me start with a small amount and going forward I might increase this amount. Be courageous when you take that decision, because it will push yourself. It will either push yourself to increase your income, because if your income increases, your savings can increase, right? Or it will push you to reduce your expenditure. either ways your savings will increase. So be courageous when you come to this number. And now this is just the first step that you will take towards financial independence. So what did I say? Financial independence? Yes. So financial independence, what is financial independence? Financial independence is when you are wealthy, when you have abundance of financial assets. So then what is asset? So Robert Kiyosaki, in his second learning that I got from him, is the definition of asset. And it completely actually disrupted actually got a lot of criticism also with this definition of asset. He said, whatever puts money into your pocket is an asset. Your car that you own is not an asset. Why is it not an asset? In accounting terms, it is definitely an asset. It comes in the balance sheet, it comes in the asset side. But गाड़ी जब आप खरीदते हो वो asset इसलिए नहीं है because the moment you take it out of the showroom, the price of the car starts getting down or starts getting depreciated. So the moment you take the car out, say suppose you bought a 10 lakhs car, the moment you take it out, it is worth say 8.5 or 9 lakhs. And every year the value of the car will go down. So is it taking money out of your pocket or is it putting money into your pocket? Think about it. So whatever asset or whatever instrument is putting money into your pocket is an asset. Whatever is taking money out of your pocket is a liability. So by this definition, your house that you live in is also not an asset. But if you have a house which you have rented to someone else and you're getting rent, is it putting money into your pocket? Yes, it is, because you're getting rent every month from letting out that house. So like if you have a house that way, it's an asset. So car, if you're renting the car out, then it's an asset because it's putting money into your pocket. So think it that way. A book, you write a book. You say suppose you write a book and you have got it published. Even while you're sleeping, that book is actually making money for you because someone is buying and you are making money. So that becomes an asset. So this brings me to the next topic, which is and very important to understand because we'll be playing a game very, very shortly. And it's very important to understand the concepts which I go ahead and speak from now on. So what are the various types of assets? Number one, equity. I see a lot of people in the room knowing a lot about equity, but at the same time, people have burned their fingers, as a person mentioned, and plus there are people who have been trading in equity for years, but not able to make that kind of money, or actually have destroyed their capital by trading in equities. So why does this happen? This happens because we have a trader's mindset, trading mentality. We buy a product to sell it at a higher price in a very short term. Suppose we buy a stock at 100 rupees, we want to sell it and book profit at 120 rupees. If the stock falls down to 80 rupees, we'll hold, but we'll not sell. But equity as an investor, see, I'm not saying nothing in the financial world or nothing with these financial instruments is good or bad, as long as you understand what you're doing. So I'm just saying this is not an investment. If you're doing this, you can call yourself a trader in equity market, but you cannot call yourself an investor, because investor is someone who's actually taken a share of that company. Say suppose, let me give you an example. Suppose you start a company, start a business. Are you trading? Are you just starting a business to maybe sell it after 3 months or 6 months? No, right? You want to build it up and create wealth out of it. Maybe it might take 10 years, it might take 20 years, but you want to create that wealth. So when we buy equity or when we buy shares, we are actually participating in the future growth of that company. As Peter Lynch once said, that earnings, like equity stocks or the stock prices, are slaves of earnings. So when earnings goes up or when earnings improve, stock prices automatically go up. And this might not happen in the short term, because as they say, in the short term, markets are irrational. There is no rationality in the market, because it is actually driven by emotions. Emotions due to a war somewhere, emotion due to inflation, this thing due to maybe interest rate hikes. There are n number of factors to take market up and down in the short term. But in the long term, there is only one reason which can take stocks up, that is earnings. If there is growth in earnings, stock prices will definitely go up in the long term. And you as a participant or an investor in equity will make money out of it. So what is equity? Equity is actually a ownership in the company, where you are actually participating in the growth, in the company's growth. So next, moving on to the second asset. Second asset is debt. See, there are two ways in which a company, say, suppose Reliance wants to have some money. Reliance wants some money to run its business or to grow its business. It can raise money in two ways. Either it can raise through equity by issuing more shares, or it can raise more money through debt. What is debt? Debt is something where, as an investor, if you invest that amount, you expect a fixed rate of interest. So if Reliance were to raise money through debt, they will, if they raise 100 rupees and they say that 8% is the coupon, they'll have to pay 8% every year on that amount, that 100 rupees. So debt is, in other words, called fixed income. As an investor, you will get a fixed income. Equity, as I was discussing earlier, and as I mentioned, will be volatile, and returns are not uniform. They could be good in the long term and better than debt, but definitely not uniform. If you might see in odd occasions where equities don't do well as debt, even debt, because equity can even give you negative return in a particular year. So that's why I said, if you are investing in equities, you need time on your side to ride that volatility. Now, speaking about debt gives you a fixed rate of interest. Obviously, there are other risks which we will talk in the due course. But for the time being, you can say that it's an instrument which gives you a fixed interest. So what are the types of debt? Types of debt could be, FD is also classified under debt, under a debt investment. Suppose you are doing a FD, and banks go bankrupt. I'm sure I actually know that RBI is kind of protecting these banks and protecting the depositors in a way. But suppose take a scenario where RBI is not there and this bank actually goes bankrupt, then your entire money could be lost, even in a debt, even in a fixed interest instrument. So FD is one way of investing in debt. Second way is, as I said, companies like Reliance and Tata also raise money. So you can invest in those kind of bonds, or NCDs as they are called, non-convertible debentures, where they will give you a fixed rate of interest. And government also issues bonds, 10-year bonds, 20-year bonds, even 30-year bonds, where you can invest and get a fixed rate of interest for as long as the horizon or the bond tenure is. So these, and obviously there are debt mutual funds. Mutual funds I'll be covering later on. Debt mutual funds is a portfolio of debt instruments which can give you a consistent return over a period of time. So now moving on, what is our third asset? Third asset is gold. Everyone knows what is gold. I don't need to explain any of that, but I'll just go ahead and tell you what are the ways you can invest in gold. You can either buy physical gold. You can invest in a lot of gold ETFs or gold mutual funds, where you can even invest monthly or systematically over a period of time. Or you can invest in government bonds, sovereign gold bonds. Those are government guaranteed bonds, which on the top of the gold appreciation will give you a small interest to couple with the gold appreciation. So this is the third asset. Now the fourth asset, and the very important asset, is real estate, where if you talk about Indians, maximum of our savings is lying in or invested in real estate or the house that we live in. So what is real estate? So any physical space could be a real estate. It could be a shopping mall, office space, the house that you live in, house that you have rented. It could be any property anywhere. All of that is pieces of real estate. And in real estate also, there are a lot of ways in which we can invest in actually real estate. Earlier, what used to happen, real estate, if we would have wanted to invest in real estate, we would have had to buy a property. So if you buy a property, we need a very good chunk of capital. So now what has happened is REITs has come up, real estate investment trusts. In India, there are only a few handful REITs listed. But if you talk about the global markets, in US, Japan, Canada, there are a lot of REITs, and even there are REITs funds who are investing in different real estate baskets. So those instruments will help you to park even a small amount, as small as say 5,000 rupees in real estate. So if you think that real estate can do really well and appreciate over next maybe 5 years, 10 years, you can go ahead and invest in REITs also, where you can just participate, invest a small amount, and you get both the appreciation. And since these are already grade A assets which are already leased and rented out, you can enjoy the rent as well, along with the appreciation on your capital, on your real estate prices. So these are the assets which I talk about.